This is a lecture on assets. In this video, you will find discussion about definition of an asset, recognition of an asset in financial statement as per framework issued by ICAI, then presentation and disclosure aspects in balance sheet as per revised schedule 6. In this slide, you will find the definition of an asset given by ICAI in a document called Framework for Preparation and Presentation of Financial Statements that was issued in July 2000. The definition is: an asset is a resource controlled by an entity as a result of past events from which future economic benefits are expected to flow to the entity. If you break the definition of an asset, you will find that an asset is a resource. The dictionary meaning for resource is a source or supply from which some benefit is produced. So an asset is a resource producing benefit. Then in order to meet the definition of an asset, you need to control that asset. Control normally comes from legal ownership. With control, we can do anything with that particular item. The risk and rewards related to that item will falls on you. However, you can still control an asset even though you are not a legal owner. For example, a lessee in a finance lease controls an asset even though is not a legal owner. Then past event. In accounting, we record only those transactions that has already happened. The asset of an entity result from past transactions or past events. So even though if you have an intention to purchase the asset, that intention does not meet the definition of asset because the transaction has not yet happened. This is the most important point in the definition of an asset. An asset is a resource controlled by an entity as a result of past events from which future economic benefits are expected to flow to the entity. So the future economic benefits in an asset is the potential to contribute cash flow to an enterprise. For example, you have an office in a rented premises. You are doing some business from the rented premises. Every month you will have to pay rent. Now you bought a new building for your office. Now you will shift your office to the new building. This new building will be your asset because you don't have to pay any rent in future for many years. So this rental saving is the economic benefits that is embodied in the new building. Now you bought one more building. This time you want to give this building on rent to others. So every month you will receive rental payments. So this new building is also an asset for you because you will get economic benefits in the form of cash receipts in future for many years. So all these rental savings in the first example and the cash receipts in the second example are economic benefits embodied in an asset. So the both new building, first one and second one, will be your assets. Also, future economic benefits in an asset will flow to the company in many ways. For example, an asset may be used singly or in combination with other assets to produce goods, like machinery in a plant. Then you can exchange an asset for another asset. For example, you have a old car. You want to exchange this old car to buy new car. So the old car is also an asset. Or you can settle a liability by giving up an asset. For example, you can pay cash to settle a liability, or you can give any other asset to settle a liability. Also, you can distribute an asset to the owners of an entity. For example, you can pay dividend in the form of cash or any other asset. Recognition of an asset in financial statements. An asset is recognized in the balance sheet when it is probable that the future economic benefits will flow to the entity and the asset has a cost or value that can be measured reliably. You can see that we use the concept of probability in recognition of an asset. This is used to refer to the degree of uncertainty attached in a business. A business is done in an environment of uncertainty. And only when we can measure the cost or value of an asset, we can recognize that asset in the balance sheet. Otherwise, we will not recognize it in balance sheet. Measurement of an asset. We have 4 measurement bases to measure an asset: historical cost, current cost, realizable value, and present value. Out of these 4, current cost, realizable value, and present value are used to calculate fair value of an asset. An asset is measured initially at historical cost. For subsequent measurement, we can use any of the 4 bases. First method is historical cost. Under this method, an asset is recorded initially at the amount of cash paid. If you are exchanging any asset for another asset, then historical cost of the asset acquired is the fair value of the consideration given. Current cost. Under this method, an asset is carried in balance sheet at the amount of cash that would have to be paid if the same or equivalent asset is acquired currently. What would be the amount that you pay to buy any equivalent asset or same asset right now is the current cost. Realizable value method. If you want to sell the asset today, what would be the amount that you receive by selling the asset is the realizable value. In realizable value method, an asset is carried in balance sheet at the amount of cash that would currently be obtained by selling the asset in an orderly disposal. Present value method. Under this method, an asset is measured at the present value of future cash inflows generated from the asset, discounted at appropriate discount rate. Here we need to estimate two things: future cash inflows generated from the asset, then appropriate discount rate. Here there is a lot of estimation uncertainty, but still many people use present value for measuring an asset. This is the format of revised schedule 6 in which we need to present assets in balance sheet. Here we need to classify assets as current assets and non-current assets. Under non-current assets, we need to present fixed assets. Under fixed assets, tangible assets, intangible assets, capital work in progress, and intangible assets under development should be presented. Then we need to show non-current investments. Earlier in old schedule 6, investments including current and non-current were shown under separate head called investments. Now we need to separate non-current investments from current investments, and we need to show non-current investments under non-current assets and current investments under current assets. Then we need to show deferred tax assets. Earlier in old schedule 6 there was no mention about deferred tax asset. Now we need to classify deferred tax asset under non-current asset. Then we need to show long-term loans and advances, other non-current assets. In current assets, we need to show current investments, inventories, trade receivables, cash and cash equivalents, short-term loans and advances, and other current assets. We need to classify any asset as current asset if it satisfies any of the four conditions that is given in this slide. First one, it is expected to be realized in or intended for sale or consumption in the company's normal operating cycle, or it is held primarily for the purpose of being traded, or it is expected to be realized within 12 months after the reporting date, or it is cash or cash equivalent unless it is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting date. The item that falls under the first category is inventory. Raw material, work in progress, and finished goods all form part of inventory. They are expected to be realized in or intended for sale or consumption in the company's normal operating cycle. What do you mean by normal operating cycle? A normal operating cycle is the time taken for purchase of assets and their subsequent realization in cash. Where for any business it is difficult to calculate normal operating cycle, then it is assumed to be of 12 months. So under the first category, raw material, work in progress, and finished goods should be classified as current asset. If any asset is held primarily for the purpose of being traded, then that asset needs to be classified as current asset. For example, stock in trade. If you are a trading company, the stock that you buy for the purpose of sale is treated as current asset. If any asset is expected to be realized within 12 months from the date of balance sheet, then that asset needs to be classified as current asset. For example, trade receivables. Trade receivables are nothing but debtors. If you expect your debtor to pay within period of 12 months, then that debtor needs to be classified under current assets, otherwise non-current asset. The item that falls under last category is cash or cash equivalent. Your cash on hand, bank account, fixed deposit, etc. will fall under cash or cash equivalent. If there are any restrictions for exchanging or to settle a liability for at least 12 months, then that cash should be classified as non-current asset. Example, margin money held with banks. Sometimes they are restricted for exchanging. Then in that case, that margin money deposit will be classified as non-current asset. The definition given for non-current asset in revised schedule 6 is any asset other than non-current asset. The items that falls under non-current asset are fixed assets, long-term investments, etc. These are the list of accounting standards which are in force as on today. AS2 inventories, AS6 depreciation accounting, AS10 accounting for fixed assets, AS13 accounting for investments, 16 borrowing costs, 19 leases, 26 intangible assets, 28 impairment of assets. I will deal with each of these standards in rest of my lectures. This is the list of new set of accounting standard issued by ICAI AS 30, 31, 32. Financial instrument recognition and measurement, presentation and disclosures. But the implementation date for this standard is not yet given. Disclosure aspects as per revised schedule 6. In the next few slides, I will discuss about the disclosure aspects for assets as per revised schedule 6. I have taken the annual report of Tata Steel and selected few schedules for our presentation as an example. First, tangible assets. In balance sheet, classification shall be given for tangible assets as land, building, plant and equipment, furniture and fixtures, vehicles, office equipment, others. We need to show leased assets separately under respective heads. Then we need to give reconciliation of gross carrying amount and net carrying amount for each class of assets like this by showing additions, deductions and any other adjustments, and also impairment and revaluation losses, depreciation, everything we need to show separately. Where any sum has been written off on reduction of capital or revaluation of assets, then every balance sheet subsequent to date of such write-off or revaluation shall show the amount of such write-off or revaluation for a period of 5 years. Intangible assets. We need to classify intangible assets as goodwill, brands, computer software, mastheads, publishing titles, mining rights, copyrights and patents, etc., recipes, formulae, models, designs and prototypes, licenses and franchisee, and any other intangible assets. Non-current investments. For non-current investments, we need to classify them as either trade investments or other investments, and further classified as investment property, investment in equity instruments, preference shares, government or trust securities, debentures, bonds, mutual funds, investments in partnership firms, and any other non-current investment. Under each classification, we need to give details for investment in subsidiaries, joint ventures, associates, and any other controlled special purpose entity. If any non-current investment is carried at other than cost, we need to give the basis of valuation for that asset. Also, we need to give details of aggregate amount of quoted investments and market value for that investments, aggregate amount of unquoted investments, aggregate provision for diminution in value of investments. This is how Tata Steel have presented about non-current investments in their balance sheet. Under trade investment, they have shown investment in equity instruments in subsidiary companies, joint ventures, and investment in others. They have shown separately, quoted, unquoted. For loans and advances, classification shall be given as capital advances, security deposits, loans and advances to related parties, or any other loans and advances. Also, we need to separately subclassify them based on the security given as secured considered good, unsecured considered good, doubtful. Also, if there are any loans and advances given to directors or any other officers of the company, or to any firms or private companies in which any director is a partner or director or member, we need to disclose them separately. This is how Tata Steel have disclosed about long-term loans and advances in their balance sheet. Other non-current assets. This is the residual classification for non-current assets. We need to classify other non-current assets as long-term trade receivables or others. Trade receivables are nothing but debtors. If we expect any debtor to pay money only after 12 months, then we need to classify that debtors as long-term trade receivables under other non-current assets. Current investments. The classification for current investments shall be same as non-current investments. Inventories. Inventory shall be classified as raw materials, work in progress, finished goods, stock in trade, stores and spares, loose tools, and any other inventory. If there are any goods in transit, we need to disclose them under relevant heads. Also, we need to disclose the mode of valuation of inventory. Trade receivables. Trade receivables are nothing but debtors. If there are any debtors outstanding for a period of more than 6 months, then we need to disclose them separately. Also, we need to subclassify trade receivables as secured, considered good, unsecured, considered good, doubtful. If there is any allowance for bad and doubtful debts, we need to disclose them under relevant head separately. Also, if there are any debts due by directors or other officers of the company, or by firms or private companies in which any director is a partner or director or member, we need to disclose them separately. Cash and cash equivalents. We need to classify cash and cash equivalents as balance with banks, checks, drafts in hand, cash on hand, others. If there are any earmarked balance with banks, for example for unpaid dividend, we need to disclose them separately. Also, balance with banks to the extent held as margin money or security against borrowing, we need to disclose them separately. If there are any repatriation restrictions, we need to disclose them separately. Bank deposits with maturity for more than 12 months shall be disclosed separately. Short-term loans and advances. Short-term loans and advances shall be classified as loans and advances to related parties, others. Subclassification shall be same as long-term loans and advances. Other current assets. If any current asset does not fit into any other category, then we need to classify it under this head. For example, miscellaneous expenditure to the extent not written off will be shown under other current asset. This is the end of the video lecture on assets. For more information, visit our website www.casolutions.in. Thank you.